In a parallel universe, Kotogawa graduates, he passes the bar, he becomes a salaryman lawyer, he works 14-hour days for a steady paycheck, and he retires at 65. In this universe, he found the stock market. The year was 2000. Kotogawa was 21 years old, and he had saved approximately 1.6 million yen, or roughly $13,000 at the time, from working part-time jobs during his studies. Hooked by the relentless ad campaigns of the new internet trading era, Kotogawa entered the market just as a historic downturn began. The US.com bubble had just burst, and it evaporated trillions of dollars in wealth, creating a global contagion that dragged the Japanese stock market down to levels not seen in 20 years. While panic selling turned the markets into a slaughterhouse, Kotogawa quietly opened his account. Needing a handle for the internet forums where traders gathered to share ideas, he chose BNF. It was actually a phonetic error. He intended to use VNF, honoring Victor Niederhoffer, but because the Japanese language treats V and B the same, he misspelled and it stuck. Niederhoffer was a very successful trader and George Soros partner, but his edge was purely statistical. He believed that markets followed strict statistical rules, specifically that if an asset price deviated too far from the average, it was mathematically bound to snap back. This approach made him one of the most successful fund managers on Wall Street. But in 1997, the math stopped working. Niederhoffer had made a huge bet that the Thai market had fallen too far and had to rebound, but it didn't. In a single day, his fund was wiped out. He lost $130 million and was eventually forced to auction his personal art collection just to not go bankrupt. So why would this young student name himself after a man who lost it all? Well, I believe that Kotogawa saw the distinction between the method and the execution. He adopted Niederhoffer's core philosophy, buying the panic dip because the math say it must bounce, but he treated the 1997 crash as the ultimate lesson in risk management. Do not trade on borrowed money. By the time his graduation approached in 2001, the 1.6 million yen he had scraped together from years of part-time work had ballooned into 61 million yen. That represents a 3,712% portfolio growth in just a single year. He calculated that the opportunity cost of finishing school was simply too high. Every hour in law lectures was costing him millions. So, with only a few credits remaining, he decided to drop out. Part 3. The Art of Catching Falling Knives. I have analyzed hundreds of trading strategies, and most of them are absolute nonsense. They are rigged to look perfect on past data just to hook gullible subscribers. But Kotogawa's strategy is different. It is brutally simple, but it is also psychologically impossible for 99% of people to execute. Kotogawa made his initial fortune between 2000 and 2004, and these were dark years for Japanese stocks. The Nikkei 225 lost almost 60%. In times like this, most investors try to pick bottoms based on hope. They buy a stock because it has fallen 50% and they think it cannot go any lower, right? It usually goes lower. Kotogawa inverted this logic. He did not buy because he liked the company. He bought because the selling was emotional. He waited for the selling to reach a mathematical breaking point, the point when the stock was simply too cheap compared to its average, and then he would buy.